This option strategy will help you control 100 shares of stock with only 30% of the capital requirement cost. I will show you how buying deep in the money call options can help you replace stock and act the same way a stock would with a leveraged return and putting up a very small amount of capital. You will never look at buying stocks the same way again after this tutorial. I'll show you how you can use $3,000 to control $10,000 worth of stock with a deep in the money call option. We're going to be going through a full tutorial of how to manage, how to open, how to close, the risks, and many examples in this video. This is going to be life-changing. So let's jump right into it. All right, so here is my little cheat sheet, and we're going to go through this cheat sheet. I'm going to leave this down in the description. It's going to be totally free. You don't have to enter any information to view this. You'll be able to view this entire cheat sheet yourself, okay? So here is what a deep in the money call option is, and here's kind of like the cheat sheet around this, okay? The purpose is to replace buying stock with buying a deep in the money or a DITM call to save capital to reduce dollar risk and to gain exposure. The core idea of buying a deep in the money call option is that it gives you the same power, the same control with less money. So you get to save thousands of dollars in capital. You get to slash risk by about 70%, give or take. I'll show you an example. We'll go through using my spreadsheet right here. We'll use SoFi as an example. And then you can produce 3 to 4 times higher returns and results on the same move in the underlying stock, okay? We'll talk about the risks and we'll talk about how to manage this strategy after I discuss my little cheat sheet here, okay? And then we'll go through a live example. So here's the criteria that I look for when I'm buying a deep in the money call option, okay? The first criteria is I want a bullish stock. I have a bullish outlook on this stock because this only works when a stock goes up. If a stock goes down, you will lose money on this leap option because this leap option is very similar to a stock, okay? We'll talk about the delta and how to choose the right leap option, okay? Now, expiration. Choose a long-dated expiration. So I wrote here about 1 year out, okay? You want to go 1 year out as those options have very low theta. They're not losing that much value, okay? I'm going to open up and already start to get into a SoFi example, okay? SoFi is a fairly cheap stock, so I typically don't use leaps on cheaper stocks. So I may show you 2 examples, one on a cheaper stock and one on a more expensive stock. So let's go to trade SoFi option. SoFi is already fairly cheap if you think about it. So you're going to get a very, very low price to replace shares. So I'll show you what that looks like. We'll go out for an expiration. Let's say, you know, this option right here, okay? So it's over a year actually, and then we'll talk about the delta in just a moment. So next thing is delta. So the delta requirement. You want to look for a delta that's over 70. The higher the delta, the more this leap option will mimic stock. You can literally replace stock, not even have to own stock, and instead have leap options. There's some trade-offs to it, but there is a lot of benefits to it. And the biggest benefit is, again, reduced capital dollar amount of risk, okay? There's a reduced dollar amount of risk. So look for a delta of over 70. So again, if I go here and I go for an in-the-money option, let's say that I go for a 23, all right? This is going to be higher than that 0.7 delta. Here we see a 0.78 delta, okay? So I'm going to click this option right here, and I already want to talk about, we're already going to start to model the risk and return here, okay? We're already going to start to model it. So right here we have a 23 strike, and we're going to pay $12.50. So I'm going to write here 23 strike, and then we're going to be paying, okay, we're going to be paying again that amount that I just showed you, $12.15, all right? So it's essentially going to be $1,215, okay? So I'm going to make this a dollar amount right now. This is going to be the premium paid, okay? The 23 strike, this is essentially the cost of the strike price. So 23 will be essentially how much capital is being tied up. And if you were to buy 100 shares of SoFi right now, you'd be tying up 2,800. Okay, so we're actually going to use the 2,800 figure. Okay, so this is how much the stock is worth. Okay, so stock 100 shares, okay? So instead of having to put up this amount, right, instead of having to buy 100 shares, you get to basically own something close to 100 shares with this amount, okay? This amount being the 23 strike price, okay? So I'm just gonna put this on the screen right here. We're gonna do a little simple math pretty soon, okay? But let's just get the ball rolling here, okay? So that's the delta, that's the 70 delta here, 70 or higher. Delta, okay, to remind you if you don't know, delta is the how much the option moves in relation to the stock, right? So if the stock moves $1 and the delta is 0.7, the option is gonna move 0.7. You're gonna get a 70% move of whatever the stock moves, okay? So 0.7, the delta explains how much the option will move, okay? Now, strike selection. You want to choose a deep in the money strike. So it's well below the current price, okay? Because SoFi is at 28 and we're choosing a 23 strike price, well, we get something that's in the money by over $5, okay? So that's called intrinsic value, and we'll talk about intrinsic value shortly. We will discuss intrinsic value and what that means, okay? So that's the strike price. Now, the break-even formula. Break-even is equal to your strike plus your premium paid, okay? So your strike here is 23 plus your premium paid. You will see that the break-even is 35, which is pretty high, which I'm not gonna lie, it's pretty high, okay? And that is the cost of buying a leap option. That's where your risk comes in. A leap option is great, but you know, you don't you need it to go up fairly high to make a lot of money. But as we'll talk about, you don't have to hold the leap option until expiration. In fact, I'm going to be showing you an example of SoFi making a pretty big move. What would happen to the price of this leap option and how much money you can make, and then how to close this leap option early, because typically I do that, okay? In the Retirement Academy here, which is really interesting, I focus on option selling strategies. And this is one of the very few, if not the only option buying strategy, which I'm going to be incorporating in the program of buying leap options and looking for opportunities during my live trading calls. The other coaches are also very much in course that leap options is how I personally built a very high net worth and a high portfolio value through leap options, specifically on Tesla. And I've done this many years ago, but I've used leap options throughout all of my trading history to really grow my portfolio. So this is one of the best, this is really one of the best and only buying strategies that I am in favor of, okay? So again, let's go back to the cheat sheet and continue to go here. So strike selection, break-even formula, capital efficiency. So I wrote here it can cost 25 to 30% of the stock value, right? So you get to save a lot of capital. In this case, it's going to save us a little bit over 50%, right? So let's actually do the math here. Let's do equals 1215, right? Divided by 2840. So this is only going to cost 42% of buying 100 shares. So here we actually get to save 57.3%, okay, in this example. But we'll have other examples that can exceed 70% savings. But this is our savings / capital efficiency here. That's how much we have. This is how much we have to put up. So it's really going to be 1 minus this. Okay, so that's actually our capital efficiency right here. We have we're saving that amount. Okay. All right. So that's the capital efficiency. Now for risk, the maximum risk is just how much you put up for this leap option. Okay. So if SoFi were to go down, well, we can go back to the chart here. Well, first of all, if it doesn't do anything at expiration, you will lose money because it will be an out of the money option. So first of all, if it doesn't really go anywhere and it just stays the same, you will end up losing some money, although you won't lose all of it because this option still has intrinsic value, meaning that there is still money to be made even if nothing happens because SoFi is greater than 23. The stock is at 28. So it's already currently worth about $5.40 in intrinsic value. And I'm taking that from taking the current price of 28.40 and subtracting out the strike price of 23. So we currently have over $5 in intrinsic value, meaning the rest of the value is really extrinsic value, okay? Keep in mind, if the market was open right now, I'm at pre-market right now, if the market was open, the cost would not actually be $12.15. In fact, it would be the midpoint somewhere between the bid and the ask. That's how you figure out the price of an option. Right now, there is a wide bid and ask because this option is very far, and that's one of the downsides of a leap option is when there's not that much volume, then the option can be hard to trade, which again is fine because we're not actively trading a leap option. We just buy and hold. A leap option, you jump in, you have a lot of capital efficiency, reduce cost, and then you wait. Okay, so it's a buy and hold strategy. But in fact, the value here would be the midpoint, okay? So the midpoint here is about 1058. So I'm actually gonna readjust this model here to be 1058 because this 12 amount is incorrect actually. So 1058, and now you can see that our savings and capital efficiency actually went up a lot. So it's actually close to the title of this video, which is what I kind of assumed. It's between like 60 to 70-ish%, okay? So now we're talking, okay? So we talked about the risk cap, let's talk about the profit comparison, okay? So this is gonna be the most exciting point before I go into exit and managing. So this is the most exciting part, okay? You're thinking, well, what is this actually worth to me? How much money can I make here? Well, let's go through an example. So let's say that SoFi stock goes up, which it has been on a very, very big bull run, okay? So if I refresh the screen right now, I just wanna show you how much of a bull run SoFi has been on, okay? And then I'm gonna show you basically, given if it were to do something similar, how much money would the stock make versus the leap option. So now we're gonna be weighing leap options versus holding stock and how powerful it is to replace the stock with leap options. Okay, so the stock went from, I mean, I've been a big fan of it in my community. I've been discussing SoFi and trading it over and over. It's the best stock for retirement. It's been the best stock. I've helped a lot of people grow their net worth and their wealth through this company. So, you know, it went from like 9 to 30 essentially. So it went up more than triple, right? It's up more than triple from 9 something to like 28 something, right? Obviously, we don't need that move again to make a ton of money. This is just the 1-year chart, and I'm looking at the halfway mark. So this has happened in like half a year. So let's say in 1 year that, you know, the stock ends up rising, not even 1 year. You can do this again in 6 months. Instead of going up 3x, let's say it goes up 2x, right? It doesn't even have to go up 2x. Let me think of something even more realistic. Let's say that the momentum continues and the stock goes up by, let's make it $15, which is a little bit over 50% return. So $15 plus 28, we're going to be sitting at about $43. And my price target long term for SoFi is about a $50 stock, but in my opinion, I think it's going to be $50 because of the multiple things that they're working on, like option trading, acquiring more customers, upselling and cross-selling those customers into more products, and just generating a ton of money through acquiring and scaling their business and doing very well with their customers, building trust, etc. Okay, so this video is not about SoFi. This is about this strategy. So let's go back here. So if 43 is the price target, right? Then how much money would we make, right? So what would we make? Okay, well, let's put it here. So if it was $4,300, that's our price target, and in 6 to 7, 8 months or so, right, the option will still have time to expiry, because if you recall, our expiration here for this SoFi leap option is in December of 2026. So let's just say, you know, we're somewhere in the summer of 2026, and now the stock is worth $43 or $4,300. Well, what kind of return is that? Well, $4,300 divided by the stock value, okay, the stock has gone up about 50%, right? So that's exactly what I was saying. About 50% was what I was trying to go for, right? And I hit 51%. Very well. Okay, but how much will the premium of the option go up? And how will this leap make money? How many times more will it be than this amount? Well, the stock went up 50%. Well, how much will the leap option go up? We're going to have to do a little bit of back of the envelope math, because we're going to have to approximate. The reason why is because if it were to go up to 43 at expiration, okay, it's pretty clear that this option would be worth $20, right, in the money, right? It's at 23, it ends at 43. Well, it's up $20, right, at expiration. Would you make money? Yeah, you would make very good money. Your $12 would turn into 20. Okay, so if you wait until expiration, you let go of that extrinsic value. And we'll talk about that in a moment as well. But you let go of that time value, and now you're just in the money by $20. So you've turned $12 that you paid into 20. What kind of return is that if you wait until expiration? Well, you know, if we do 20 divided by 12, you get a little bit higher of a return. It's like 67% return. But that's not where the magic is. That's not where the magic is of a leap option. Because I don't personally recommend, not that I'm a financial advisor or anything like that, I've retired myself through my own strategies and through learning on Wall Street hands-on how to trade options. I've studied this stuff. I've worked with financial advisors. Myself in the field was working there, but again, this is educational purposes only. But in my opinion, my recommendation is that I don't personally hold a leap option until expiration. Okay, I usually manage it earlier. And then again, in summer of 2026, about halfway, a little bit more than halfway, when we hit the price target, I believe 4,300, this is what's going to be the value of this leap option. So first of all, we obviously know we're going to have an intrinsic value of about $20, but then we're going to have extrinsic value as well. We're going to have more time value, okay? How do we calculate that? Well, we can calculate that by taking this delta, okay? Okay, this delta, I told you that it represents how much the option moves, right? So if it's a 76 delta, okay, let's go back here and let's kind of do a little bit of simple math, okay? I'm going to do it right over here. So we have a 76 delta, correct? Now the stock is going to go up by $15, okay, by 15. So if we multiply the $15 move multiplied by the delta, we're going to have a move here of about $11.40, okay? So this option will become $11 more valuable, okay? So it's currently worth $12.15, and we're estimating a move, a additional move of about $11.40, okay? I'm not taking into account, oh, excuse me, actually, this option says $12.15, but we're using the $10.58 number, okay? We're using the $10.58 number. So it will go up by $11.40. So what will be the new value? Well, the new value, okay, will be 1,140, right? Because it'll go up by 1,140, and each option is worth 100 shares. And we're going to add that to this, okay? That's going to be the new value of our option, of our leap option, given the rise. And in all reality, I am not factoring for some other factors. There are other factors such as gamma and theta. Theta erodes the option, although it's very, very, very small, especially on a leap option. So the theta is not going to be all that high. Gamma also kind of affects delta. So the more the stock goes up, the more the option's in the money, the higher the delta will be. And how do you know that? Well, we can see that a more in the money option here has a higher delta. Okay, it's a higher delta. So in the future, when this option goes up, well, the delta is going to be higher. Okay, it's going to be higher. It's going to be tough to say by how much exactly, because there's multiple factors here. There's a long period of time, but you know, it'll probably be about, let's say, 80 delta. So I'm just going to change this to about an 80 delta because that's pretty much what it's going to be. It's going to be a bit higher, okay? So now we have $12, okay? I'm just going to readjust this because it's hard to say exactly, but I'm going to readjust this. This is a rough calculation, and it'll be very, very close to this. So that's going to be the new value of the leap option. You can probably already do the math. If we take this and we divide it by the price of the leap option, you get a 200% return. So you can see here how this leap option, the math that I'm doing here, this is how you build and scale, and this is why it makes sense to replace stock with leap options, because not only do you have a lower dollar investment up front, you have a higher return on capital. You have a higher ROI. This leap option is going to make more money if SoFi hits $43 per share. I'd rather personally lose 100% of an $1,800 investment than lose 50% of a $7,000 investment, for example, right? So the risk management on a leap option is always going to be a fraction of the stock. So I love when people say options are risky. It means that you don't understand risk because the dollar risk is much less. Most traders, they'd rather avoid losing 500 than gain 500. So they end up holding losers too long and selling winners too early. And the leap strategy is also beneficial psychologically for those types of investors, which is a majority of investors, because it's lower upfront capital. Deep in the money means that the strike is well below your stock price. You have immediate intrinsic value. This is where professionals play. They ignore price tags and they focus on payoff odds. Retail traders rarely do this, but the leap strategy has intrinsic value right away. It's already worth something. So that's what makes it such a strong strategy. I have come to look at Delta, by the way, as equivalent shares. Write that down. I have come to look at Delta as equivalent shares. In other words, when you see a delta of 80, okay, that 80 delta that you are looking at for a call is very similar to renting 80 shares of the stock. To correctly calculate the leverage that one takes with 80 delta, it's essentially taking 0.8 times 100 shares of stock, which gets you 80 shares. So think of it as leasing 80 shares and you're only putting up 50% of the capital. That is way more efficient. Every dollar the stock moves, you get to capture 80%, but you're only putting up 40% of the capital in many cases, right? For SoFi, it was not as attractive because I actually picked a cheaper stock. I'll show you something like a Tesla where you're just going to make way more crazy money. Also, don't forget inflation. You have a built-in 3 to 7% invisible advantage on whatever delta odds are because this option is 1 year out. So naturally, inflation as it goes up, the stock market goes up. That's why the stock market is a wealth building machine. It goes up over time. So actually, your LEAP option is going to benefit even from inflation itself. So here's some of the exit strategy and expiration I want to talk about. You pretty much want to sell the option to take profit or loss before expiry because theta really kicks in the last 30 days and starts to kind of kick in the last 90 days, okay? So you really want to profit from this option sooner than that. You don't really want to exercise, but if you were to exercise, you would need 100 shares worth of capital for every one contract that you have. I personally never ever exercise. It doesn't make any sense because you let go of all the time value left on the stock, okay? You can also roll, and this is a more advanced topic that, I can talk about pretty much in the community. It's going to be, this is more advanced, but you can also roll and you can also do a lot with a LEAP option. But to keep it simple, 6 months, it's a good time to take profit. I wrote here always use a stop loss because a lot of people, when they're new to LEAP options, the market can go down. So you can set a stop loss for the percentage drop. So let's say that you bought this LEAP option for $10, you could set a stop loss for $5. So if it were to go down to a value of 5, you would get out of it automatically. So that's one of the exit rules that you can set for a long-term LEAP option. So remember, all investments carry risk. This reduces dollar exposure, but not market risk. We still have market risk, right? We are still long call options on a stock, right? So I told you I'll talk about Tesla, and we'll go over one more example right now. I'll show you how you can kind of make really good money on something like Tesla, okay? First of all, in the last 3 months, Tesla's up like 34%. So again, you don't have to use Tesla or SoFi. I'm just showing you an example, okay? But Tesla is going to be a very, very good choice as well because it has high implied volatility. It has strong momentum. So if you're a Tesla fan, then this is going to be good. By the way, again, this is in the description below. I have this sheet is free. I also put in the link to the Options Retirement Academy if you want to see the leaps that I'm buying and help you reach retirement. My whole goal here with the Option Retirement Academy is we have several coaches, myself included, where we do live sessions, and we do that daily. So you get to see what we're trading, go over technical analysis, and look for opportunities to scale your portfolio and reach retirement, produce income. And we're all experts that have basically retired, so we're all at 7 figures. So you can check out that in the description, the whole cheat sheet as well to just kind of guide yourself. Now, okay, so let me show you how Tesla will work. So again, we want to buy an in the money option that's going to be about 70 delta. This is 75 delta, very similar. Now, a stock like Tesla has a lot more that it can move, right? Obviously, in big bull market, stocks can literally double. So if I go here for Tesla and I pick a 350 option, okay, we can essentially do all of this math again. I'm going to make this a little smaller here, and we're going to just kind of, we can kind of start from scratch actually. So let's go over Tesla, TSLA, and now we're going to go for how much does the stock cost? Well, the stock costs $432, and this is a really good one because a lot of people cannot really afford to buy a whole lot of shares of Tesla. So LEAP options are even more valuable, okay, when it comes to something like Tesla because it is expensive. So again, 100 shares would cost roughly this amount of money, right? But now we can buy a call option, a deep in the money call option. So right here, the 350 for $150. Okay, so very easy math. So we're going to buy it for $150, which is actually still going to cost a pretty penny. It's still going to cost 15. It's going to cost 15,000. But 15,000 is much better than 43,000. Wouldn't you agree? So the strike price, I'm just looking at the strike price, is 350. Okay, so it's going to be a 350 strike price. All right. We can do the capital efficiency again. So I'll just kind of copy and paste this formula, and we'll do the capital efficiency again. Here we get a little bit higher of a capital efficiency. That already tells me that we're probably going to get a bit higher of a return. So we get a bit higher capital efficiency here, okay, which is nice, 60 to 70%, right? So let's call it about 67% or so. So here we go. We got 62, we got 65. In my experience, I've used even better than this. I've seen capital efficiency go up beyond 70. I think for me, the average is 67% I've seen. So I get to save about 1/3 of the cost or so. Or I get to pay about 1/3 of the cost. I get like three times leverage factor there. But okay, so now we have the stock 100 shares. We have the premium. Okay, so now what we need to do is we need to put a price target. And we've seen stocks like Tesla. If we go back here, let's go to Tesla real quick. And again, the delta, okay, let's just go to Tesla real quick. Over 1 year, stocks like Tesla can go up 40%, but over 5 years, obviously the stock's up hundreds of percent. So let's just say we're Tesla bulls, okay? And again, I'm just using Tesla as an example, but let's say that you're a Tesla bull and you believe in Elon Musk's mission, and he has some big goals, etc. And essentially you're looking at the stock being a $700 stock, okay? That's fairly high, but for example's sake, let's use 700. Okay, so the delta here is 0.76 again, so it's about the same. It's about the same delta, all right? So I'm going to copy this actually, and we're going to go right here, and I'm going to paste this, but we're going to go for 0.76, right? That's the delta, all right? So that's delta. And so we're going to go up to $700, okay? That's a big gain. So $700 minus the 400 is going to be, so 700 minus 400 is 330, so it's going to be about 270, 268, okay? So it's going to be about a $268 gain, okay? Which means the option is going to go up about $200, okay? So we kind of have all the new numbers here again. This is delta, this is dollar rise, okay? And this is option price change, okay? So that's going to be the option price change. So, okay, so our new price of the stock is going to be 700. Well, what does that mean? How much money did we make? Well, if we made, so let's go here. So it's going to be 70,000. It's going to be the new price, and we're going to subtract this, right? The cost that we pay. That's how much we make, okay? What's the percentage return? Well, it's our gain divided by how much money we put up. So the stock will go up 62%, right? Yep, 62% gain. Okay, cool. Let's do the option value. So we're going to take this amount, okay, which is the option price change, plus the amount that we make on the option, the amount that it costs to begin with, which is 15,000. So when we add, okay, sorry, we have to actually multiply this. Okay, we have to multiply this by 100, right? Because each is 100 shares. So it's going to make that amount, right? So that's going to be our new value, okay, $35,000, because we made about 20 grand on it. So we're going to take this and we're going to divide it by our premium, and then there we go. So here we make a bit more money, not a whole crazy amount more than the SoFi example, but a bit more. So we do 235% return in this example on a leap option if Tesla were to go to $700. So whereas the stock only goes up 62%, you go up 235%. So 235 divided by 62, it's 3 to 4 times more, right? So again, going back to my cheat sheet here, I wrote how you can make 3 to 4 times more. Yep, there you go. 3 to 4 times more. So we hit exactly that number. So yeah, if you appreciated this tutorial on buying deep in the money leap options, I'd love to give you more insight, more coaching during my live sessions, as well as some more live technical analysis, fundamentals, and how to choose stocks to do leap options on. Of course, it's a very strong strategy. I'd love to have you part of the Options Retirement Academy. So if you're interested in that, it's going to be in the description. And then this free cheat sheet is all yours. You can access that by just clicking the link, and then you can visit this. You don't have to submit any info. It's just publicly available to you as the viewer. So yeah, thank you so much for watching, and hope that you enjoyed this tutorial.